Welcome to the daily update, where I'll go over the action in the market for Thursday, July 18th, and then we'll see how things look for Friday, July 19th. Pretty much a more significant down day on Thursday. A lot of the losses that we saw on Wednesday came from the gap, and the market did go down after that, but it was really the gap move down. Where on Thursday, we saw an initial positive open, we hit resistance and then started to come down. One of the things we need to deal with right now is at this point, it still looks like a pullback, but are we going to see further weakness in the large caps and mega caps that are going to drag down this improvement that we had been seeing in the small caps? That could kind of change things longer term and make it look more negative. If we're seeing the small caps and mid caps holding up better, and once this decline gets over with the large caps and the mega caps, and then they come back and start looking good too, okay, that's more positive for things. But we'll just be watching that day by day to see if this scenario is shifting somewhat. Before I get started into the video, I do have a thing called the SPXInvesting Program. It's wide open right now. It's free. Feel free to check it out. There are additional things that I post there that I don't post anywhere else. And just see if this is something that is of interest to you. There are links below this video in the description that'll either take you to more videos where you can learn more about that, or you can go to the site itself. And if you want to contact me, here's an email address. Also, the videos that I do, like here we are on Friday, and I'll be doing a lot of videos over the weekend. All of those weekly videos are just supplemental to the daily video. I feel that's where the most use comes from, how I analyze the market and reach conclusions. So let's go back and talk about what happened. We did have a higher open. Futures were fairly positive. It looked like, okay, maybe we're going to get a little bit of a bounce. Wednesday's action might have been a one and done kind of thing. Well, it started out looking like that. We had a higher open and we went above the daily pivot at 55.99. So we were back to dealing with that 5,600 level again. But then we hit resistance, and this ended up being the high for the day at R1, which was at 56.12. That was the positive part of the day. Then we declined back down below the daily pivot and the unchanged level. This looked like, okay, maybe we're just going to fill the gap. We go back down to the unchanged level. That's more of a built-in support when we're going up and we fall back. Well, that's not what happened. Prices tried to find support below the unchanged level at S1 at 55.75, but then we fell down below S1. We got down to S2 at 55.61, and then we went down to the level of the 20-period moving averages. We attempted to bounce up off of that, but then we fell down to S3 at 55.23, and we closed slightly off the low. We did come back and close at the 20-period moving averages. So for right now, the short-term trend is hanging in there. That's really the first line of support. We fell through it, but we were able to come back to it. We were down 0.78% on above average volume, and we're still looking okay in the short, intermediate, and long term, but we are starting to see weakness develop. Can these 20-period moving averages hold? Can things come back in and start to turn more positive? We're seeing some of our indicators actually switching over negative, and we're not in, to at least a large degree, any kind of an extreme positive condition. We're actually showing a few indications of an extreme negative condition already. So here are some comments. This was more broad-based. There were some areas of strength in Thursday's session, but we saw pretty much across the board with all the indexes being down. The parabolic SAR has turned negative. That's one of the big ones that we're seeing. The dot has now gone on top. That's a primary indicator. And so to me, that's quite negative. Now, we saw this a few weeks back. It lasted a couple of days. Then we saw an upthrust. Then the parabolic SAR turned back positive. We don't know if something like that's going to happen this time, but it has now turned negative anyway. Our short list for the short term of extreme positive indicators, we still have the ADX, but now it's starting to roll over and drop below its moving average. And then the stochastics, which because it's broken down into 3 further subdivisions of the short-term time frame, it takes a while for this chart to lean one way or the other. Intermediate term, we just have the Stoch RSI. It never did get extreme positive when we were going up earlier in the week and even last week. And then the intermediate term ADX, also still looking extreme, but coming underneath its moving average now. And we went down again, so the VIX is going up. And so we're getting a pretty extreme reading with the RSI that we put on the VIX. We're still looking kind of extreme, though, with our 150 and 200 period moving averages. They've come down a little bit, but not very much. So the long term really isn't seeing much of an impact, at least to this point, over the last 2 down days. And then the rate of change going back 200 periods, it's still extreme positive. And the scenario really hasn't changed all that much. The market is really, really convinced right now that there's going to be a rate cut in September. And so they're pretty much counting on that. That's what they're doing things in the market based on. If that ends up not happening, that could also turn things more negative. The dollar was up and interest rates were up. This also pressured stocks. We closed at 4.19% with the 10-year yield, where we had been at 4.15%. We're still inverted with those yield curves, and now we're well beyond the 2-year mark for that. And because of the additional down day, we're dropping even further into neutral territory as far as sentiment, where we came in at 51. Last time we had been at 54. And our trend is still positive. The green line's on top, but it's coming down. But now it's a weakening trend because we're dropping below the moving average, but we're still above 20. So it's still a trending environment. With the additional down day that we had on Thursday, our bias is negative, and then I've switched our momentum to mixed to negative. All right, then we had the weekly initial claims. This came in stronger than expected at 243,000, where they expected 225,000. Last week we had 223,000. The continuing claims also were up, not very much, 67 million to 1.847 million. And the Philadelphia Fed index was stronger than expected at 13.9. They expected it to be at 2.9. Last time it was at 1.3. The leading indicators, and I have a couple of different charts to show you of that one. It was down 0.2%. They expected it to be down 0.3%. Last time it was down 0.4%. Okay, here are the weekly claims. The gyrating black line, that's the number that we get each week. We follow mostly the blue line, which is a 4-week simple moving average, and it had been going up, then it was starting to drop off. Now the moving average is starting to go back up. We're seeing more of a sustained trend here when we look at continuing claims. So even though it came in a little less, we are still going up overall, which could suggest a little bit of lengthier unemployment in the employment situation. And here's a chart just kind of trying to put everything together. And then I break it down on a shorter term time frame, where the blue line, those are the continuing claims, which are going up, and the initial jobless claims, which the trend has them going up. And then the latest unemployment rate that we got at the beginning of the month, it's at 4.1%. Here is the first chart here, included with some headlines. The LEI, Leading Economic Index or Indicator. It was negative, but to a lesser degree compared to prior months. So the blue line is what we're following here as it's going back up. It says that the decline that we saw was led by consumer sentiment. Folks are not real happy right now. New orders also declined, and then the yield spread. That's what we've been watching, at least with the inverted yield curves. That's one thing, but we've also been watching the risky versus not as risky spread. That seems to be improving over the last few sessions, but that had been kind of becoming a bit of a concern. And then the unemployment, we're seeing some pickup in that. And you take all of that together, and that's why the LEI is still negative, but less negative than what we saw last time. And here's a different look at that chart with these red lines on here. When we fall below the red line, that means that we're looking at more of the idea of going into a recession. And that's what's happened before. We go below this red line, and then we see the grayed area for recessions. Well, we dropped below the red line, but at least to this point, we have not gone into a recession. Here's some Isabel Net blog charts. Now there's a negative part and a positive part here. This is a longer term chart, and this is what we look at every day. I show this chart because it looks different and it's represented a little bit different. And this is looking at the 52-week highs and lows, and where we've been going up, and so we're seeing a lot more green than red. That's positive, and that's more what I focus on. If you take a little bit longer look, as the S&P has been going up, we are seeing a negative divergence here with fewer new highs, but we were able to break out of that recently. So that is showing a real improvement there. I don't focus on that as much because the 52, it's more of a rolling thing, and we can really show minimal improvement with the new highs compared to what was read before, where it's actually more positive than what it may look like at the time. At least I do notice the negative divergences, and sometimes they do play a major role, but a lot of the times it's like we just like them going up because that's an internal measure of what's happening in the market. Okay, and then we have to have one of these charts every couple of days. The 5 largest companies as a share of the S&P market cap, those 5 companies make up 29%. And a lot of those 5, and I don't know which 5 companies they're referring to here, but they've been under pressure lately. So that's why we've been seeing the S&P and the NASDAQ 100 declining. And then this is kind of interesting. This is Long Magnificent 7, the most crowded trade. This is what are most people doing right now. Most people, at least at the time this Bank of America survey was taken, show that that's what people are doing. They're in the Magnificent Seven stocks, and it's even been increasing as those stocks were going up. That could end up being negative. This is a very high reading, and so we could use that as a bit of a contrary indicator. Say, well, if that's what everyone's doing, it's about time for that to end. And then the Japanese yen, which is in a downtrend. And so people have been shorting it. And wouldn't you know, it's been bouncing back up. That's kind of interesting. I don't follow the Chinese equities all that close, but there are people that are shorting that market, but it's not as much as it was. There's also, okay, people shorting small cap stocks. Well, what have they been doing lately? Really going up. And gold, which is a lot of people are really into that, but it's not as much as it had been because it has kind of been stalling out as it's been chopping more or less sideways. So we can look at this to say, okay, this is what people are doing, and that justifies other people doing the same thing. But when it gets kind of extreme, or what it's the cool thing to do, that's a lot of times when it's run out of steam at that point. Okay. And then this is looking at net profit margins. And of course, you have to take out financials and energy just to not have an apples to reality comparison here. But the takeaway from this is that we are looking better going forward, and that is positive. And the bottom up. Now, this bottom up is different from when they do an analysis for their earnings per share, where they take even additional factors into consideration. Bottom up is where they're just looking at the stocks themselves. And we're seeing earnings revisions still going up 22% here for the top 10 stocks, where the S&P itself has been down 1%. And then you take the rest of the stocks out of the S&P 500, and the earnings per share the revisions are actually being revised down. Okay, then we have new privately owned housing units authorized by permit housing. Okay, this is building permits here. So we're just seeing an increase here where it had been falling off, and now it's starting to trail back down, and this can be often a leading indicator. I found one interesting chart here, and I'm not sure which book this is taken from. It's just a screenshot that somebody showed here, and I teach this kind of thing in my course. But it's just kind of a good reminder what to look for. Bullish, strongly trending markets are easy to spot. Unfortunately, sometimes you spot them, but after they happened. And it's when the 20 period moving average is above the 50. And we have charts that go through that. Both the 20 and the 50 are going up. Okay. You do it. What's the direction of the moving averages? And then the distance between the 20 and the 50 is large and getting larger. There's a spread between the two. And then pullbacks, and could be where we're at right now. Pullbacks in price reach only the 20 period moving average, or at the most, they're between the 20 and the 50. Well, as of Thursday's close, we're at the 20. They do not reach all the way down to the 50. This is what we're going to be watching for. Are we going to hold that 20 period moving average support level and start to bounce up off of that? So far, it has held. We even dropped down below it in Thursday's session, but we came back to it by the time of the close. All right, here is the chart. And this is what I'm talking about, where from Tuesday to Wednesday, we saw the gap lower and then not, excuse me, and then not a real big movement after the cash market actually opened. And then this was actually looking more positive on Thursday, where we had a higher open above the daily pivot, but boom, we topped out right at R1. Then we came back down below the daily pivot. We came down, really, the unchanged level didn't end up providing really any support at all. We came down to S1, tried to bounce back up. Now the unchanged level was acting as resistance. We fell down to S2, right down in here. This was about where the 20 period moving average was at. We tried to come up off of that, and it looked like, okay, maybe we'll get a nice little bounce. Well, then we saw some selling, which actually took us underneath the 20 period moving average, came down to S3, and then bounced a little bit off of that going into the close. And looking here where we did look at a higher open, there was initial fall off here, but we were clawing our way back. But then by the time we got into the cash session, things were just not doing so well. And that's where we saw the move lower. Okay, now we're seeing both value and growth going down, but value is still outperforming, at least on an intraday basis, since a red line is on top. And we saw a little bit of a pickup later in the day. This could potentially be encouraging. We've been seeing S&P growth to value intraday really trailing off as the market's been under some pressure. But this late in the day bounce back up might help things. Our end of day chart growth was down, but it was down less than value for the large caps, down less for the mid caps, and down just a little bit less here for the small caps. But it was a negative day across the board. When we look at our end of day growth to value ratios, the small caps, this is really falling off now. And the mid caps is also falling off as well. And we saw a little bit of a tick up, but we have been falling off after seeing some strength with the S&P growth to value ratio. And we're seeing a little bit more of a decline into the rainbow here when we look at the growth versus value ETFs. And we saw, after a nice improvement, discretionary to staples have been going up. Well, that's now starting to fall off, as we saw a little bit of a bounce here in staples and a little bit of a decline in discretionary. Large cap growth, this is where we're seeing some of the weakness right now, just coming off of setting a recent all-time high, and then it's been going lower here. And this is what we're going to be watching for. Are we going to come down and test the moving averages here? This is the 50 on this chart. I don't have a 20 period on here, so we'll be keeping an eye on that to see if more weakness ends up actually leading to lower prices. And then the large cap to small cap ratio, it actually ticked up a little bit because small caps were also under pressure in Thursday's session. And then the Wilshire coming off of setting a recent all-time high, but was down as well, but still above its 50 period moving average. And then this is where we're starting to see a bit of a shift, where the ADX is now dropping below the moving average and the green line is going down. What we're going to be watching for is if the green line keeps falling and the red line comes up, that's a cross at that point, and that's when we would actually switch over negative. And then at that time, we would be likely to see the ADX continue to decline. And this was producing a concern because we were getting above this 40 level. We got above it with the green line above 40, and then we've been declining ever since. And now we're starting to see some weakness in the overall trend. And we're seeing it a little more pronounced here. We got above 40 with the green line, and we've been going down. We're falling below the moving average here as well. And we are starting to see more days above average, at least lately. And we're going to see one on Friday because it's options expiration. But typically during July and August, that's when volume will drop off on the NYSE as well as the NASDAQ. And sentiment, we're picking back up again here with the Ulster Index. We're still under the moving average, but we're starting to come back up with this. The latest reading from Investors Intelligence, which we came out that I talked about in yesterday's video, came in at 3.81. And we're seeing a real increase in the VIX. The line chart here, that's the closing value. It's really starting to go back up as we've been going down. We're also seeing the bar chart continue to go up as well. The VIX of the VIX is also showing more movement in the VIX. So we're going up with the bar chart as well as the line chart. And the momentum of the VIX also continues to be up. And we're going up pretty quick here. So our VIX using an RSI based on 9 periods is extreme now. And this is what we might be seeing, where we're seeing lower readings earlier in July, and the VIX on a seasonal basis will often start to increase. And coming back up into the red area here with the skew index, we came up, we dropped down below it. Now we're going back up into this red area. Is the market still expecting some more of a big move? And at least to this point, the move appears to be to the downside. And we're also getting a pretty high reading here with the VIX to S&P 500 correlation. We're above this dashed line. This also may suggest a negative move when we get a high reading like this. And we actually went up here, not a real surprise with the daily equity put call chart, but we're still declining with the 5 period, and we're extreme. So that's when I pull out this other chart. We're getting down below this green line, which can often be more negative for the market. But in our 10 period still continues to decline as well. We were up with this fear gauge. We were also up with the other fear gauge. So we're seeing more confirmation there. And the risk on to risk off ratio is coming back down. We got up to the high end of this range that we've been in 2024. And since that time, it's been pulling back. And when we look at high beta versus low beta, this is continuing to go down as the high beta stocks have been under pressure. And we're coming down to the top end of the band with our volatility risk premium, but now we're starting to pick back up a bit here. And we had the latest reading from the American Association of Individual Investors. They were real positive a week ago, but not quite an extreme positive reading. And we're turning down, but still holding up okay here when we look at the advanced decline line based on price and volume. But we'll have to see if there's further declines going forward. And we're looking pretty good here, even though there's a drop off in the new highs with that thrust up that we saw at the open. That produced a nice another new set of all-time or new highs. And in the chart that I showed earlier, this is the negative divergences that they're latching onto, but we pretty much have broken above that now. So internally, this is still looking okay. We're going up with the 5 period and the 10 period this way. And we did decline down a little bit after being somewhat extreme positive with the 19-day advanced decline ratio, and we declined, but we're still positive with the 39-day. And this is where we're starting to see a little bit of concern. We're coming back down to the moving average, and so the boom indicator is coming back down close to 0. If we drop below the moving average, that's when the boom indicator will turn negative as well. And we're turning negative now with the Chaikin money flow. We've actually dropped down below 0. And this has been a concern all along. This is why I didn't enter into any positions this week that were bullish, because this had been really dropping off. We were seeing some extreme readings with the accumulation distribution, and we're turning negative here with the Chaikin oscillator. And we're coming back down to the moving average with the NYSE cumulative advanced decline line, but still looking okay when we look at the regular advanced decline line, even though it did decline. Also coming down a bit, but still above the rising moving average with this other NYSE advanced decline line. And coming back down with the common stock based on price on the NYSE, coming down also based on volume. And when we look at S&P on a cumulative basis based on price, we are coming down, but not really seeing anything all that too bad yet. Just a little bit of weakness here. And we're declining both with the S&P and the NYSE advanced decline line, so they're having a tendency to go down together. And still rolling over a bit with our advanced decline line studies, but we're still above the moving averages with all of the indexes. Short term, we did fall below this pivot point here. So that support level was lost. We're going to see if there's anything else. If we And I don't put the 20 period moving average on here, but we're right at that level. If we fall below that, I do have the 50 period on here, which currently right now is also lining up at a pivot level. On the bottom, we were above average with volume. We're extreme negative with the Stochc RSI, and we're coming down in the short-term stochastics. We're no longer extreme and declining in the intermediate term. We're still extreme, but declining in the long short-term stochastic. And we're dropping further below our double and triple exponential moving averages, and the lines are starting to roll over. But we're still right at the 20 period moving average. So we'll see if this level can hold. As of Thursday's close, it's still there since we closed right on that level. We're coming down with the 20, 50, and 200, but they had been quite strong as of late. We're turning negative, though, with the force index, and we're right back to the midpoint when we look at our standard deviations chart. And intermediate term here with the balance of power declining, but still above zero. We're still looking more neutral after being positive with the dark blue bars. We're now seeing the second day of the lighter blue bars. And we're coming down to the midpoint here as well with our highest high value. The TTM squeeze continues to look more negative as we show the dark colored blue, and we are declining with the overall oscillator. And we're dropping down below the 50 period double and triple exponential moving averages. The lines haven't quite started to roll over yet, but we're going to want to see this get back above this level to turn more positive. And we're still far away from the 50 simple and exponential moving averages, so I haven't been showing those charts. We're declining with the ease of movement, but still above zero. We're pretty much flat with the Erin indicator and still looking positive. After being extreme with the S&P McClellan oscillator, we're coming down and no longer extreme, but we're still positive because we're above zero. And when we're above zero, that means the summation index continues to go up based on price, but we're starting to top out a little bit here based on volume. This led the turn up when we were going higher. Could this be starting to tell us that it's turning more negative, as it could be beginning to roll over here based on volume? And we were extreme with the NYSE McClellan oscillator. We're dropping down, but still above zero. So we're continuing to go up with the summation index on the NYSE based on price and volume. Turning down after being extreme with the Swenlin trading oscillator based on price, and we are declining based on volume. We're still positive since both of these are above zero, but we have more of a negative context here because both are now declining. And we're starting to roll over with our momentum, crossing below the moving average here with the PMO and above this red line, giving us an extreme positive reading, but we're still going up based on price and volume. And no longer extreme with the PMOs that are rising. So that's coming down, starting to roll over with the buy signals, starting to top out potentially with the PMOs that are above zero. We've gone from being positive to neutral to now negative with the Elder's Impulse system for the S&P. Here's the big change. The parabolic SAR with the decline, the dot is now on top. And we're rolling over here with the slope oscillator. It's pretty much on top of its moving average, but it has been showing some weakness, and we're still above this green line. That means an extreme reading. And the MACD has been a little bit more responsive to what's happening. It's dropping below its moving average. So we're seeing some weakness with the short term. The TSI has already started to head down. The intermediate term with the MACD, we're below the moving average, crossing below with the PMO, but not quite there yet. Crossing below with the PPO, coming back down to the moving average with the TRIX, and pretty much on top of the moving average with the KST. And we're declining here with the Sean trend meter after being extreme positive. Here is the 20 period moving averages right here. And we closed at those levels, or at that level. But this is still looking okay. The bullish percent index inside the S&P actually went up slightly. And we're going up with the NYSE bullish percent index. But we're now dropping negative when we look at the NASDAQ 100 bullish percent index. And the vortex, green line's on top, but it's going down as the red line is starting to come up. This will switch over negative when and if the green line and the red line cross. The money flow is declining, but still above 50, where the ultimate oscillator has already gone negative. We came down, but we're still above the advancing moving average with on-balance volume. After just starting to cross over positive with the Copic curve, we're now starting to drop back below the moving average and turning negative. We're no longer extreme with the RSI based on 14 or 9 periods. We're coming down to this 50 level here with the RSI 9. The reason I have these these boxes here, and I should extend them to where we've been at lately, but when we spend most of the time above 50, that just shows good upward momentum. And we were seeing that lately. Well, now that we're starting to drop below 50 with the short term, are we going to spend some time down here, which is where you see the red box, and that means that the momentum is more negative. And after being extreme and looking quite positive, the stocks inside the S&P above their 20-period moving averages coming down, but still looking fairly strong. And our study here is coming down a little bit. If we go back and say, okay, how did things go out in March 2023, where we came up, went down, rattled around down here, shot back up, and we didn't immediately just shoot up after that. So this is not really giving us any real major warning signs at this point. Stocks above their 50-day moving average is declining, but still above 50. Stocks are still declining above their 100-period moving average, but still positive. And after giving us an extreme reading here with those stocks above their 200-day moving average, we are seeing a decline. And then this is a chart that comes back into play from time to time. This is a 20-period simple moving average of the open, high, low, close. Since we're dealing with the 20-period moving average, we often see one of these lines act as support. Is that going to happen this time for the stronger uptrend to go back to continuing? Still looking good here, though. Weekly chart of the S&P, we're still above this R2 level. After coming up to the 61.8% extension level for the SPY, we're now dropping back down. And we're seeing a little bit of a more negative picture here. The Heiken Ashi is looking more negative with the dark candles. The Kegi chart, it's black, so that's positive, but it is pointing down. The Renko chart, it's like, what? Everything's fine according to me, but we're seeing a little bit more negativity here with the 3-line break where it's turning black. Long term, we're still looking extreme here with the 150 and 200, even though these moving averages are coming down. Here's the rate of change going back 200 periods. After getting above the blue line, we're now starting to come back down and just barely ready to drop below it. And we're still negative with the NASDAQ 100 in the short term, where all the other time frames are still positive. And we're still negative with bonds in the long term, where we're negative with commodities in the short term. The dollar is looking negative in the short and intermediate term. No change yet from the decision point scorecard, and we had a whole list of things that happened here in Thursday's session. Started off positive, so you'll see lots of blue and green here. Then when we were going down, you see nothing but red as the NASDAQ just seemed to tick off 100 points after 100 points. The tech sector, this is negative. We had a BPI cross below 70 after it had been stronger. And then when we were bouncing up a little bit later on, we did see a bit of an improvement here to help things a bit technically. And so we saw healthcare actually be down the most, followed by financials and discretionary, where energy ended up being the strongest area, and it didn't show any gangbuster strength. And tech was up just a little bit as far as looking at the tech sector. But we're still looking good here. With our broad market measure of the 5-period moving average of the highs minus the lows, it's still going up. And our daily score of the new highs minus the new lows, it's coming down, but we're still well above zero. And looking at the weighted versus equal weight S&P 500, they're both going down more or less in tandem. So we're seeing this coming down as the bigger stocks are now underperforming the equal weight version of the S&P. And the Dow, which set an all-time high, did fall down 1.29%, but it's still well above its 50-day moving average and still above this R2 level. The diamonds have gone from being positive over to neutral. The NASDAQ, after breaking below this pivot point, is declining, but still above its 50-day moving average. NASDAQ 100 also still above its 50-day moving average, but we're turning negative when looking at the Qs with the Elder's Impulse system. The momentum for the NASDAQ 100 continues to be negative. And we're dropping down from this 50% extension level, and now we've actually dropped down below the 38.2 extension level, according to this chart. And the Qs are now below their 20-day moving average. They lost that on Wednesday, but they stayed below it again on Thursday. Could they be coming down and testing their 50-day moving average? And the small caps, after just skyrocketing up, did fall almost 1.5%. And we've gone from being positive over to neutral with the Elder's Impulse system. And we're also coming down after getting a really extreme reading when we look at the Russell 2000 small caps with the RSI. Coming back down now based on the bar chart, but still above the 50-day moving average. The shorter-term momentum continues to be positive. And the mid caps came back down and fell below this R2 pivot level, but they're still above their 50-day moving average. We've gone from being positive to neutral with the mid caps when looking at the Elder's Impulse system. Total stock after ETF here, after setting an all-time high, has been pulling back, but still above its 50-day moving average. The staples to tech ratio has been spiking back up, but we're not breaking above this 50-period moving average, at least yet. Financial sector, after doing really well, did see some pullback in Thursday's session. And the FANG index, after setting a recent all-time high, it's been drifting lower as the mega caps have been under pressure. The dollar was up, and it's still in an uptrend here on the daily chart. And Apple was down over 2%. You have Amazon down 2.22%. Microsoft down 0.71%. Google down 1.84%. Meta was up 3%, and NVIDIA was up 2.63%, bouncing up off of its 50-day moving average. And Tesla was up 0.29%. And again, the longer we can stay above both of these moving averages, the more likely we are to see a golden cross, and that could be more positive. And Netflix was down 0.68%, also just falling a little bit under its 50-day moving average. So when you take all of this together, these are the big Magnificent Seven stocks. You could put Broadcom in here somewhere as well. But when they see a lot of weakness, that really drags the indexes down. Looking at a bit of an advance here with the 10-year yield. And so we saw a decline with the 10-year based on price. And this is still looking okay and is showing an improvement. When we look at home construction to 3 to 7 year bonds, we had really come up out of the rainbow. We fell back a little bit, but we were up in Thursday's session. And looking at the S&P versus the world index, starting to see a trailing off of the short-term correlation and still continuing to decline with the longer-term correlation. And we're seeing a real breakdown in the growth to value ratios with the Qs to S&P coming down a little bit here with discretionary to the S&P and still above the advancing moving average. We're seeing more deterioration here when we look at large cap growth versus large cap value. So the large caps, mid caps, and small caps are all showing weakness with this ratio. The S&P to utilities ratio did tick down, but lately it has been going up, and that's more positive for the S&P. Can it start to go back up is the question. And still coming down with the 2-year treasury yield here. That could also give support to the S&P. And the staples to S&P 500 ratio is starting to go back up. That could be more short-term negative. If we can resume this more pronounced decline, that would be more positive for the S&P. And then we're waiting to see if we're going to get a confirmation with the Hindenburg-Omen. We still have not received that, at least yet. And we're not getting any recent confirmations here with the NASDAQ either, with the Hindenburg-Omen. So what's our outlook for Friday? We're still positive. We're declining down to the 20-period moving averages. And so far, this is still just looking like a pullback. But it's going to be options expiration. And when we get to the seasonality chart, we are quite negative on this day. We're not going to have any economic reports. And then all the different geopolitical things. Of course, a lot of the news right now is dealing more with the presidential election and what's all happening with that. And no reports in Friday's session of significance. Nothing to show here. This is where we're looking quite negative seasonally. On July 19th, we're quite negative with the Dow, S&P, and the NASDAQ is even more negative. Only 19% of the time has it been up on this day. And seeing some negativity here when we look at during an election year with the green dashed line. But Friday is it's number 2 as far as being positive after Monday. And still trying to maintain a bigger picture look here, looking as we go through July and into August, where we don't go straight up here. We do have down times along the way, but during the 4th year of a presidential term tends to be positive. And now we're starting to wonder, have we passed this second Christmas here for the NASDAQ? We have based on a time basis, and we could be starting to pass it now based on the historical basis. And this is where we see a bit more chop is in July. It actually looks a little bit better when it's not a presidential election. And we're wondering, are we starting to revert back down to the mean, looking at these averages of the seasonal tendencies? And we're now coming into the second half of July, which ends up being positive, but quite a bit less than the first half of July. And we're beyond this now. We're coming into the 18th, where according to the Carson research, the positive seasonality could be starting to go away. And we were well above what we usually experience on an average basis. So not only could we be hitting a negative seasonal time, but we could be starting to revert back down to the average. So what are the warning signs? We're still just keeping an eye on staples, utilities, and healthcare, with energy kind of being a wild card and all that. The growth to value and discretionary to staples ratios, they're declining right now. So they're really not looking very good. The Chaikin money flow is now negative. I should have put that in gold here. And the Chaikin oscillator, that should also be in gold, because I consider those to be primary indicators. That has turned negative. The parabolic SAR is now negative. The ultimate oscillator, the Copic curve, is turning back and looking negative. And we're looking at the momentum for the NASDAQ 100, and the bullish percent index is now crossed below 50. Positive signs, accumulation distribution, but we're just hanging on. If we see any more weakness here, we could actually turn negative by dropping below the moving average. We're still looking positive with the S&P and NYSE McClellan oscillators and summation indexes, even though they did pull back. And that's better when you're looking at the broader index, the S&P, the other stocks, and the NYSE is also a broad market measure as well. So that seems to be holding up for right now. The bullish percent index is above 50 and actually went up in Thursday's session. The Swenlin trading oscillator, it's declining in the short term, but it's still positive when we're above 0. The equity put call ratios are still going down. And the advanced decline line, they are still positive, even though they're pulling back now. Our oscillators are positive, but they're extreme, and now they're starting to roll over, but they haven't quite turned over negative, at least yet. The money flow, the vortex, and the bullish percent index continue to be positive, as well as the financial sector. So our conclusion, we're still positive. We're seeing more broad-based declines. At least that's what we saw on Thursday. On Wednesday, it was more the big mega caps and large caps. We saw pretty much across the board selling on Thursday. This still just looks like a pullback because we're at the 20-period moving average. And that's what we're looking at here in the short term. We really are no longer extreme positive with anything. And we're also no longer extreme positive in the intermediate term, but we are declining. If we fall below the 20s, the 50s will be the more intermediate term level that we'll be watching. But we're still looking pretty good here with the longer term. We're above the 200-day simple moving average and almost or somewhat a little overbought at this point. So thank you. I hope you have a really good day, and I will talk to you in the next video.